Good afternoon everyone and welcome to the Morrows Monthly Update for September. Last month the market faced many challenges, including the conflict in Syria, elections in Australia and Germany, and also continued discussion by the US Fed over winding back its stimulus. Looking back though, these events acted as tailwinds for the market. However, we note that late in the month markets did sell off over concerns of a looming US government shutdown. Despite the late sell-off, the Australian equity market finished the month higher, up around 2%. Global equities were also stronger, with the US up 3%, Europe up 4%, Japan up 9%, and emerging markets up around 7%. Global bond yields fell from their recent highs during September, primarily as the US Fed took a backward step in relation to its tapering of stimulus. Commodities were generally weaker during the month as event risk subsided. We saw gold prices down around 4% and oil prices down around 5%. The US dollar was broadly weaker against most major currencies, with the Aussie dollar finishing higher than the US by around 5% and also rising relative to the euro and the Japanese yen. US economic data had a positive tone in September, with both the manufacturing and services sectors beating expectations, house prices rising, and also inflation coming in lower than expected. Whilst the unemployment rate fell to 7.3%, we note that the participation rate also fell to a 35-year low. In Europe, data was positive, with both manufacturing and industrial production beating expectations and business confidence improving. The unemployment rate also marginally fell, but we note that it remains near record high levels. Data coming out of China was positive, with the manufacturing sector expanding, and also industrial production and trade data beat expectations. In Australia, we saw business confidence and consumer sentiment improve, house prices rose, and GDP growth came out in line with expectations. On the negative, however, retail sales and manufacturing data disappointed and the unemployment rate rose. At its RBA meeting in October, the board left rates on hold at 2.5%. The macro events from September turned out to be positives for the market. However, as we move through October, the market faces a new challenge which requires the US government to pass a budget and also agree to raise the debt ceiling. Whilst history would suggest that markets will be volatile over the coming weeks, given that we're going to see headlines around a government shutdown and the potential to default on debt. Whilst we expect an agreement to be reached, we are in the hands of politicians, and we acknowledge that the longer this does drag on, the more negatively markets are likely to react. Given this uncertainty, we're not looking to increase risk through portfolios. However, in saying that, we continue to look for investment opportunities that reward investors for taking on risk. We thank you for your time and we look forward to talking to you again next month.